free cash flow of $784 million for Meta, a company that threw off $8.5 billion in the same quarter a year ago.
Down 91%. And the ads didn't collapse. Revenue grew 28%. The cash went into capital spending on data centers, 31 billion of it in a single quarter.
So the top line beats, and the stock still drops 9% after hours. And Zuckerberg spends the day before the print in the Wall Street Journal, accusing OpenAI and Anthropic of regulatory capture. So the question everyone came out of it asking, did the open source AI strategy break the earnings?
And I think the honest answer is more interesting than either side wants it to be.
Take me to July 29th. What did the numbers actually say?
Revenue 60.8 billion, up 28%, past consensus. But diluted earnings per share came in at $6.18, against a consensus around $7.17 to $7.22. So a 13 to 15% miss on the bottom line, while the top line beat.
Usually when revenue's strong, earnings follow. What's different here?
Not when your costs jump 55% year over year. Two things loaded that. There's about $3.5 billion in charges the company calls one time. A $2.4 billion legal charge they didn't fully explain, and $1.2 billion in severance from laying off about 8,000 people in May. And then the structural driver. Capital spending of $31 billion in a single quarter, nearly double the $17 billion they spent a year earlier.
And that $31 billion is basically their entire operating cash flow for the quarter.
Operating cash flow was $31.86 billion. CapEx ate almost all of it. That's why free cash flow lands at $784 million. So the question I keep coming back to is what's really driving the spend? Is the open part of the strategy doing the damage? Or would a closed Meta be sitting on the exact same bill? The strongest version isn't about the word open source at all. It's about owning the full stack. Data centers, chips, software. On the call, Zuckerberg said that stays important for long-term control and performance. And that leaning on third-party models isn't viable because open-source models aren't as strong as the frontier ones.
Wait, so he's arguing he can't rely on open models while running an open-source company?
He's arguing he has to build his own frontier models internally, rather than license anyone's. And building them yourself is what forces the $31 billion. And the transcript gives you a second piece I find harder to wave off. He flat out said there's nowhere near enough compute for all the demand, and that it would be foolish to sell all his compute for a short-term profit.
Meaning he could rent that capacity out, make money on it today, and he's choosing not to.
He's choosing to keep it for Meta's own products and its ad recommendation engine. That's a live revenue sacrifice, and it shows up in this quarter's numbers. It's the platform logic of owning everything, and it has a direct earnings cost.
So, on that read, the strategy really is dragging the print.
On that piece, yes. Where it gets weaker is when people say the open weight distribution itself inflates the cost.
Because Microsoft and Google are spending like this too, and neither of them gives their models away.
And that's the concession the four side has to make. Every major player, OpenAI, Google, Microsoft, is running a comparable buildout, regardless of open or closed posture. A closed-source Meta would need nearly the same capex to build frontier models. Open weights don't add to the cost of building a model. They only add the cost of maintaining it publicly, and that's tiny against $31 billion.
So, the distribution decision and the spending decision are just two different things.
They are. Does Meta's capex carry an open-source premium, money it wouldn't spend if it went closed, or is the spend identical either way? The evidence tilts toward identical.
Then, there's the boring explanation, the $3.5 billion in charges.
The CFO, Susan Lee, said on the call that stripping out the legal charge and the severance, operating income would have been 9% higher year over year. Now, that's Meta's own arithmetic, not an independent read, so I'd hold it there. But even discounted, a big share of the miss is a legal hit and a layoff, neither of which has anything to do with open source AI.
But one time is doing a lot of work there. A layoff driven by AI replacing roles, youth safety litigation that keeps coming, those don't feel like they happen once.
That's exactly the fault line. If those charges recur, The one-time framing that normalizes the miss is misleading, and the real earnings trajectory is worse than even the CapEx story says. We don't know the source of the $2.4 billion legal charge. That gap matters.
Here's what I keep snagging on. If open source is the villain, is Meta even really open source anymore?
This is the piece I find most persuasive against the whole proposition. Their newest model, Muse Spark, launched closed, despite the Llama open-weight identity the company built. Critics surfaced that during the media campaign. And on the call, Zuckerberg said Meta has always planned a mix of open and closed models, and that they expect to get back to releasing some open-source models at some point soon.
Get back to. So it's paused.
Right, and read the timing straight. The spending is climbing at the same moment the open posture is receding. If open source were genuinely driving the CapEx, you wouldn't be quietly stepping away from it at the frontier while the bill goes up.
And the media blitz, the op-ed, the interviews, accusing OpenAI and Anthropic of regulatory capture, all landed July 28th.
Both camps actually agree that campaign served a lobbying function. The dispute is whether it was reactive spin to get ahead of a bad number or a prepared plan. And a week-long campaign with a Wall Street Journal op-ed plus coordinated New York Times and Financial Times interviews takes weeks of editorial setup. Even Microsoft CEO endorsed the distributed AI vision publicly. You don't assemble that in response to a quarterly miss.
So, the timing looks suspicious, and turns out to be prepared.
The timing is suggestive, and I'd hold it at moderate. It's plausible he knew the print would disappoint and wanted investors looking at the long-term fight instead. But you can't get from suggestive to proven on the record we have.
There's one number we haven't touched, and it's enormous.
Reality Labs, a $4.62 billion operating loss in the quarter, on $431 million in revenue. That burn would dominate the earnings math on its own, and it has nothing to do with the open source question. It's a separate long-cycle hardware bet that predates this whole AI debate.
So, when we ask, did open source cause the miss? We're stepping around a $4.62 billion loss that was already there.
And meanwhile, the app business threw off $23.39 billion in operating income. The core is healthy. Impressions up 14%, average price per ad up 12%, and both camps agree on that. So the miss isn't a failing ads business. It's everything piled on top of a healthy ads business.
So, where's the record actually thin?
3 places. 1. The source of that $2.4 billion legal charge, undisclosed, so we can't judge whether it recurs. 2. Whether the severance and litigation are genuinely one-time or the front edge of recurring pressure as AI reshapes the workforce. And 3. The biggest one. Meta is the only major hyperscaler without an external AI cloud revenue line to point to.
Google has cloud. Microsoft has Azure. Meta has ads.
Its AI spending flows back mostly through better ad targeting. No standalone receipt. So the open question underneath all of it, can Meta turn this infrastructure into money outside advertising? External compute sales, enterprise services, subscriptions, before investors run out of patience. If that line never appears, the CapEx to earnings bridge never closes, and the strategy is indefensible at this scale, whether it's open or closed.
What would actually move this for you?
Watch the Q3 print against their own guidance. They guided $61 to $64 billion in revenue, and the midpoint sits below the roughly $63.2 billion analysts expected. So they've already handed investors a second soft data point. If Q3 comes in soft and free cash flow stays crushed, the one-time story dies.
And the CapEx floor.
They raised the full-year floor to $130 billion, the second upward revision this year. If they lift it again, the spending isn't stabilizing. And watch for any disclosed non-ad revenue line, or an actual open-source frontier release. Either one tells you which story is true.
And if that legal charge shows up again next quarter, the boring explanation stops being boring.
Then it was never one time.
So, did the open source strategy cause the miss?
My read, the build-out caused the miss, and the open source label is mostly along for the ride. The real cost is the compute Zuckerberg won't rent out. And after $31 billion in a quarter, he still can't show you where the money comes back from, outside of ads.
This episode is grounded in a world-by-flow analysis, drawing on 18 web sources. Thanks for listening.